Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, a lot of things are happening in the markets right now. Markets dropped down a lot today. The housing market, though, is very scary. The home builders, which are very resilient, getting hammered today. Your home value is going to plummet because of what's going on with the home builders. We're going to talk about this in detail. You're not going to want to miss this. Let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, one thing I like to look at least as far as market stability, is home builders. Guys like Buffett are big on home builders. I think they actually went in recently and bought a bunch more, but they're pretty resilient. And the only time we really see them draw down is when we're having market downturns. And yet here we are, and I know we're going to look at KB Homes in particular, but it's pretty scary structure here. And it's dropped quite a bit today on a huge earnings miss, which is really unusual for home builders.
Yeah, Phil, it's almost like whatever's starting to happen now should have happened a year ago. It seems like we've been put on pause, and maybe these guys just didn't believe Powell. Maybe, Janet Yellen's activity, kept everybody at bay, maybe because a lot of people had locked down fixed rate mortgages, but the horse left the stable, right now, and it's running free. And the first chart I want to show you guys is, it just drives me nuts because there's so many, homeboys on real estate. And, the difference between real estate and stock market is if I'm wrong, I'm out. In real estate, if you're wrong, you're screwed. In real estate right now, look at this bubble, Phil.
I know.
You can't justify it, especially in an environment where wages in aggregate are not going to keep up. Don't let any of these clowns tell you that people are getting positive wage inflation against real inflation. They are not winning, right? Because the costs in other sectors of their spending is just eating it all up. And that's just not everybody. We're just seeing the headline stuff. And so I want you to comment on this, Phil. 191%. We are literally 91% overvalued, which means that in aggregate, housing prices have to fall in half, which is unheard of. Well, this rise has been unheard of in the history of housing bubbles, except for probably during the Great Plague, where 25% of the population disappeared in Europe. And they had, when they had castles being abandoned, you couldn't sell a property during the 1500s because of that. That's a serious thing too, by the way. So Phil, what do you think about this?
So the housing bubble, I think you're going to get a mean reversion, right? It's just, what is going to be the mean reversion? Is it going to be 30%, 40%, 50%? Those are crash type drawdowns. But again, if you look at the parabolic rise in home values, very reminiscent of, 08, when we, peaked out in that field. And, you heard about everybody buying McMansions, remember that? And, just everybody was in on it. And, that was a different mechanism that got us there. People were just putting down what they made, stated income, and nothing was verified. It was just sell because of the packaging the mortgages into security products, right? That was a new thing, new toy. So, they were just trying to leverage that and juice that market. But we got a similar situation because instead of, let's say, Wall Street and one of their games juicing the market, you had the Fed directly juicing the market. And, we've shown you guys a lot of charts like the M2 supply. M2 supply went parabolic. What do you think is going to happen to asset values? They're all going to go up, all that stimmy money. So basically, now that the Fed is saying no, it's higher for longer, the market, I think, finally digested that they're not going to budge on that. Finally, for some reason, it took this long, and the Fed funds futures are now pricing in what the Fed's been saying. So at the poker table, the market capitulated against the Fed versus the Fed capitulating against the market, which has not been the case in, last few years. Fed's always come in, capitulated, right? So now the market's digesting it. So that brings in, okay, are we really slowing down? I think we've shown you guys enough data that we are slowing down. We made a comment yesterday. Powell kept saying how resilient the consumer was, and we're seeing data that's quite the opposite in the charts that we're looking at, right? So he's not telling the truth there. He's trying to make it sound good, and that's just a buffering thing that they do. So I think it's all going to come down. So it really depends on like how far down. Now, if you look at the income to housing cost ratio, that's a problem, right? I think it was at 30%, now it's climbed to 40% higher. So what that means is, in terms of, if you're looking at the market in what people make versus what housing costs are, that income to housing cost ratio is about 40% over the mean. So I'm thinking that that's really going to be, I know it says here on the chart that inflation adjusted home prices are 85% overvalued. I don't know that we're going to get an 85% correction, but I do think it's more realistic that we get back to that mean on the income to home value ratio, because that's really what's going to drive buyers to come back in, right? Is to get back to that mean. So I do think we have the risk of a 40% drop, which if I saw 40% drops in some of these markets, even in Hawaii or some of the more expensive resort destinations, I think that would bring back buyers even at higher interest rates. So I think that's kind of the spot. Any 40% and below, below 40 would be a bonus, I guess. But you never know if things get off the rails here with the economy. You could get more than a 40% drop, and it would be a housing crash and likely a market crash in general. So that's why cash is king in that situation.
Yeah, and this is stating 40% is about right. The other thing too is, we'll show you this chart later. The week's almost ending already. Jeez, but gross domestic income's falling too. So not only do you have that, it's the numerator and the denominator are going the wrong way together, and so it's going to be problematic. But what's really been weird is the home builders. So I want to throw this chart up here on KB Homes, Phil. KB Home announced they plunged. They're at a point now where they're losing their pricing power, they're losing their volume. They're probably stuck with expensive land. So I was doing some brokering back in the day where we were finding private money for home builders and regional guys. And so we never really lent land because it's too volatile, but they would pledge your land as collateral, and their collateral just got smoked in the 2008 down frame. And so that's happening now. These guys, either they don't have land and they're finishing out their projects, and they may sell some of these things at a loss, or they have land that now is worth less. They probably collateralized it for loans. And so I think the home builders are in big trouble. The market finally is recognizing it. Phil, if you want to throw that chart up, this market's just been asleep. Finally got a breakdown out of the head and shoulder pattern here. Now, Phil went ahead, and I'm going to let Phil talk. I'm going to make one comment. I'm going to throw it back to Phil. So when you see a head and shoulder break like that, a lot of people push in to short it, but you usually get a bounce back to that neckline. So if you want to short KB Homes or any other head and shoulder breakdown, let it come back to the neckline and do the kiss goodbye. And that trade will be a lot more profitable for you. And Phil, you drew some measured moves and gaps, so I'll throw it back to you to go ahead and talk through that.
Yeah, you're right. So at some point, they're probably going to backtest that neckline around that $48 area, which would be, I think you're going to see shorts come in or sellers come in. And the reason for that mechanism, a lot of times you will go back and back test where you broke down from, the big support area that broke. And really it's because people are stuck there. So when price comes back, they're happy to get out of break even. So that's why you get that resistance there. And then people see the selling volume come in, and then they jump in on that as well, and they get short. So you're looking at that price action to get short, and then you're targeting the big support resistance area at 40.50, which is that line down there, that first blue line. Then you have these gap fills that never really got fixed, all from the bottom of last year. Basically this KB Homes bottomed with the market and came up with the market. The head and shoulders pattern here is much cleaner than we have on the S&P 500. That's kind of to be expected on a single stock versus an index. Things get a little more messy on the index, but you got all these gap fills. Basically what that is just inefficiency on the way up. And when we get those types of moves and we get a correction, typically the price is going to seek out those areas, and market makers will basically rebalance those areas of inefficiency. They got left behind. So market has a funny way of getting back to those levels. So you got 36.79, 31.85, and 27.10. And if you think those numbers are a little too ridiculous for where we're trading at, we essentially did that same thing in 2022. And the mechanism for 2022 was the same thing that we're going into here in the Q4, which is after this month, we're going to go back to longer term debt issuance, and that sucks liquidity out of the market. So they've juiced this market while they could. Now we're going to get a correction. We're going to have the ammo in terms of what the Treasury is doing to bring this market back down. Don't think these numbers down here are out of reach. They're not. And in fact, you could potentially see the lows of last year taken out, not only in KB Homes, but the rest of the market. So I pay attention when the home builders are doing something like this and putting in this type of formation, because they're confirming what you're probably seeing in the overall market and the economy. These guys are really resilient, and they only drop when we have economic problems.
Yeah, and for you guys listening, listen to Phil, because he's spent most of his adult life around the custom home building industry. Okay. So he knows this business cold. And these are light switch moves, right, Phil? I mean, it's either risk on or risk off for these builders. So, bank lines dry up, suppliers disappear, buyers disappear, and you go from feast to famine in this industry, right?
You do. And KB Homes, and some of the other bigger country-wide builders of, median homes, when they start faltering like this, right? Because home building's like big part of the economy, right? You got to have homes, the economy, the population's expanding and things like that. But if they're faltering, then every segment of construction is usually going to get hammered. Luxury especially will be like you said, it's going to be like a switch. If you're in the luxury segment, I would be shoring up the dam and I would be making sure you got a nice fat war chest, and I'd be very shrewd about your hiring and your crew size, because like I said, this can come very, very quickly, and it looks to me eerily similar to what we went into in '08. And overnight, projects either were canceled, banks called loans, they couldn't finish the project, prospects basically said we're putting our plans on hold, and probably a good 1 to 2 years before it felt like we were getting some sense of normalcy back, really going into like 2010 from that '08 debacle. So this can be a messy time period for a lot of people. And there's going to be a lot of contractors that don't make it out of this. It happens every cycle. So, and some of the newer guys, just like traders that haven't been through the '08 stuff, right? This is going to be all shocking to them, or they won't believe it, right? Disbelief. But I would be preparing everything right now. If I was a contractor, I would be very defensive here.
Yeah, and guys, this is serious stuff. This is not a 1 or 2 month event. This is probably multi-year for sure, maybe into the next decade. Just be careful when you're out there, in the home building. The power is going to be in your hands if you're a buyer. If you're a seller, your home better be pristine, or better be in a pristine location, or you're gonna suffer some pretty big equity drawdowns. And the other thing too, we didn't talk about is the back to work thing. A lot of people in these, what I would call these tertiary cities, these ex-urban areas, that people bailed out to, those cities are going to get hammered the worst, because they're definitely trying to call these employees back to the main offices, and it's going to be a big problem for people.
Yeah, there was an article of a realtor, I think it was a Redfin Gold Star realtor or something like that, and she had said that in Boise, that was one of the hotter segments, right? People relocating to Boise, and they were coming from areas like Seattle and California because they were able to work remotely. So she has 2 different clients. They work for the same tech company out of Seattle. They all have to sell because they're going to lose their jobs, because Seattle is saying you need to come back to work and you need to be in the office 4 days a week. Well, they can't do that from Boise, practically speaking. So they're going to take 6-figure losses on their homes because they all bought into the peak to relocate. And the reason why is because they could get a much bigger house or property out there versus Seattle and still keep their job. That's over. They got to sell not only a 6-figure loss, they got to go back to a home that they said would be half the size, according to her. So that's going to be part of the phenomenon too, right? This comes down to, we're at a standoff, as we said. We got to have that inventory catalyst. These are the things that are going to cause that. For those of you that think, the Airbnb guys are going to flip to long-term rentals, well, guess what? The rental market is softening. And why that matters is because they have a nut to cover on those homes that are not their primary. They're their second and third, fourth properties. Those have to cash flow. If they don't, they'll be forced sellers.
Airbnb filled the gap yesterday too. We told people in 140 it's going to come down and fill that gap. Broke right through it. I'm rolled down now to 130 in October on my puts. I think Airbnb. Remember in June, Airbnb was $100 stock, and articles galore about just the absolute cooling in the hospitality industry right now. People are not traveling, and we know it too, because my wife's in the hospitality, I would call services business. So when people travel, my wife's busy, and we've seen probably a market slowdown in people taking trips that are my wife's clients, and she's high end. So when the high end people don't travel, look out.
Yeah, and after Labor Day, I think you mentioned this too, Bob, in your area. Labor Day got soft, I think, as far as what you saw in terms of people in restaurants and things like that. And interestingly, I talked to somebody in the tourism industry here in Hawaii, and they said same thing. After Labor Day, it fell off a cliff, and it's more back to, because this isn't a peak season over here, so it was kind of getting back to normal, which was the first time I had heard that since we had the COVID spike and everybody decided to stay home and travel. So it seems like things are coming off now. I think the big tell will be now as we get into November, December, which is a seasonal peak for tourism here. If that doesn't start hitting the numbers, I think we're going to know that, and I'll report back on what I hear, but that we're going to know then that we got some serious issues, because if Hawaii tourism is down, that's because people aren't spending money. That's going to feed into a recession.
Yeah, absolutely. I mean, I'm going from full restaurants to 1/3 full restaurants in my area. And so I know we're rambling today, but it's really important. And I know two people in the IT to cyberspace, right? The hottest space. One's an analyst and one's a salesperson, managing partner, both gone. Whoosh. These are 200K plus jobs gone. I mean, they spent $12 million on a year begin splash with their whole firm, and then they laid off 20% of their staff 60 days later. So, I mean, this stuff's happening fast. And so just be careful out there. And the market's just starting to reflect that now.
Yeah, so let us know what you think. How's things looking in your neck of the woods? I know we got viewers from all over the country, all over the world. Love to hear what you guys are seeing as we progress through the end of the year. Thanks for watching. Please hit like and subscribe. Appreciate all the views and likes. They've been increasing. We love it. Love to have you guys around. Also, check out what we do over at tradegenius.co. We'd love to have you in the room where we can help you navigate these markets day to day. Thanks, guys. Thanks, Bob. We'll see you on the next video. Take care.
Trade Genius.